Hi everyone, I'm Paul Orfanos, National Community Engagement Manager at Delphi Bank, which is a division of the Bendigo Adelaide Bank, and welcome to Delphi Connect, a segment where, as part of our commitment to community engagement, we bring you leading experts from fields as far and wide as economics and the markets, health, scientific research, the arts, community affairs, just to name a few. Hopefully you'll find our segments both informative and enjoyable. Let's move straight on to today's guest, David Robertson, Head of Economic and Market Research for Bendigo and Adelaide Bank. David, welcome to our segment.
Thanks for having me, Paul.
David, it's been a big weeks in the areas of economic policy, elections and trade, and it's on these issues that I'd like us to focus on today. Now, let's tackle them one by one. There's been talk about interest rates soon turning negative. How likely do you think this may be for wholesale markets on the one hand, retail markets on the other, and please explain to our viewers what constitutes, if you could, a wholesale deposit?
No problems, Paul. Well, firstly, I don't think we'll go to negative interest rates, and the Reserve Bank in their latest cut, where they reduced the official cash rate to 0.1 of 1%, and they equally reduced the target for 3-year bonds down to 0.1% and the term funding facility. Their messaging, I think, was pretty clear that if they need to do more to help the economy, that they won't be reducing the cash rate anymore or either of those other measures. Need to do more, that they'll address that by doing more bond buying and quantitative easing. So I think that's sensible that they're not tempted to go down the path of negative interest rates because, to be frank, we don't really have a lot of evidence that it's been particularly successful in Japan and in Europe, where they've been toying with, or they've actually been in negative interest rates for some time now, whereas in other parts of the world there's been consideration of it, but not many countries have gone there. So I think it's sensible that the Reserve Bank have made the observation that they think it's extraordinarily unlikely we'll go there. Nevertheless, if things do get worse, and let's say, the type of outbreak in COVID-19 that we had in Melbourne, which required a second lockdown, let's say you got that in another location, say in Sydney or Brisbane or somewhere else, and suddenly the economy deteriorated again, which we don't expect to happen, then that's a lever they could pull. So look, if that did happen, I think it's important to keep in mind that a negative interest rate, really, it's a benchmark that would go to a negative number, like a bank bill swap rate or a term swap rate, and those benchmarks are used. For example, you add a margin to those to get a lending rate, and the lending rate still turns out to be a positive number. It's just the starting point is lower than it would otherwise be. So really, the world of negative interest rates is more for wholesale markets and for interbank markets, and indeed for, in the case of Europe and Japan, the deposit rate that the central bank pays to commercial banks for parking funds with them. And so really it's an incentive for those banks not to leave surpluses with their central bank, but instead to lend it out. So, it's not as though even if we did, say, go to an official cash rate of minus 0.25%, it's not as though there'd be, retail branch deposits with a negative number attached to them. There'd probably be more deposits that are very close to zero, if not at it. But it's really a benchmark that would be lower. And, the other part of the question is around, well, what exactly is a wholesale deposit? And this is really the sort of institutional part of the market. It's for fund managers and for really investments in the tens of millions of dollars. And, admittedly, around the world, there are quite a lot of bonds trading with a negative yield, and fund managers, if that part of their mandate is they've got to have some of their funds in AAA rated securities, a lot of them are trading with a negative yield. But I think it's important to draw that distinction between that sort of institutional market with wholesale deposits versus, where a mum and dad investor would be, or even a self-managed super fund.
Thank you, David. Do you feel that it's time for the fiscal relief policies adopted in Australia to move from short-term income relief support to long-term productivity building support?
Yeah, so look, at the federal budget was certainly mainly focused here on that short-term fiscal support, and it needed to do that given everything we've been through with COVID-19. I actually think the federal government, probably all levels of government, are trying to achieve both those things. They're trying to address the short-term imperative, which is those short-term fiscal support measures, job seeker, job keeper, home builder, the whole range of them. And at the same time, I do think that the government has been proactive in trying to address longer-term productivity enhancing aspirations. I think they're trying to do them in parallel. So how do you achieve those longer-term needs? And we definitely need productivity enhancement, because without that, you're going to struggle to see wage growth. You're going to struggle to see improvements in standards of living, so it's a requirement over the medium term. I think infrastructure investment is one way of achieving that, and the government, all levels of government, seem very keen to achieve, to spend on infrastructure investment, both to create short-term jobs and to get the medium-term payoff. The government's also talked about at a federal level doing more around industrial relations and skills gaps and so on. But look, you could always do more, and perhaps you could say that we would benefit from more coherent, energy policy, for example, or climate policy, and maybe we could do more around tax reform. So look, we need to keep working in parallel on the short-term imperative, the longer-term aspirations. But look, just on the fiscal support we're getting in the short term, I think it's important to keep in mind that the federal budget made that commitment, and also made the commitment not to unwind that, not to go to budget repair until we've got the unemployment rate back safely below 6%, well below 6%. So it's not as though the short-term support's going away in a hurry, and indeed it won't go away until the economy can stand on its own 2 feet.
It's certainly a balancing act.
Absolutely.
The unconventional economic policy of quantitative easing has now been adopted in Australia as another arm of the federal government's stimulus efforts. How successful, David, do you think this policy will be in assisting families and business owners?
Well, look, Paul, I think it has been successful already, and I think it will help. It's just one policy, lever that can be pulled at the same time with a range of other policies and support measures. And the reason I think it's been successful already is that it's got down not just the cash rate, but the term rates down to much lower than where they would otherwise have been. So if you think about 3-year fixed rates, if we didn't have quantitative easing, then the 3-year rate would probably be anywhere up to about 1% higher than where it is today. So it's been very helpful that the quantitative easing has pulled down the 3-year rate in the, if you like, the interbank wholesale markets, and that flows through to broader markets as well. It also helps with government debt, because it means that the cost of all the government debt that's being accumulated as they pay for all these support measures is a lot cheaper than it would otherwise have been. So, I think it's helpful when it's done in parallel with a range of other policy measures and support measures. It's not the be-all and end-all. And I suppose the other thing that a quantitative easing does is it increases the amount of supply of money in the system, and that can help keep a bit of a cap on the Aussie dollar. If the Reserve Bank hadn't undertaken quantitative easing, then I think you'd see the Aussie dollar a lot higher than where it is today. So it's again part of that balancing act.
And now, David, to a topic that's captivated many around the world over the last few weeks, the US election. With Joe Biden now president-elect of the United States, what do you think the implication will be on world trade of a Democratic White House and what is now looking like a narrow Republican majority in the Senate.
Yeah, and look, it's probably important to keep in mind that Joe Biden, having won the popular vote and having achieved the number of seats required, is only the presidential elect. He's not actually in the chair until I think it's January the 20th, and I'm not sure the incumbent seems to be rushing to hand over the keys. But look, assuming that all goes through the correct process with the court challenges and so on, then you get your transfer of power. That's the thing that I think the markets were a bit nervous about prior to all of this, that there might be a complexity to the transfer of power, and that the court process might be messy, and the fact that the markets are coping so well probably suggests that the consensus is that those appeals will be dealt with relatively quickly. But as you mentioned, whilst the Democrats appear to have won the White House, they haven't won the Senate, and so Congress is more evenly balanced. And I think that's probably, again, the markets, in particular equity markets, have liked the sound of that, because it's not a massive lurch from the right to the left. It's not a massive immediate change of policy. And in particular for Wall Street, it's not an immediate thought of increased corporate tax rates. So, a gradual transfer and a gradual transition. I still think that Biden and Kamala Harris and the Democrats will be, far more multilateral in their approach, a greater willingness to work with or to achieve consensus, to work with the World Trade Organization, World Health Organization, and the UN and so on, and really an attempt to drive, a bit more global stability, if you like, and for the US to go back to its standard role of being a leader in trying to push liberal democracy. But when we go back to the question around trade, it's still unclear to me what's going to happen with the US-China trade wars, the tariffs that the US has imposed on China, and then you've had the tit-for-tat tariffs that China have imposed on the US. I don't think they're going to go away in a hurry, but probably suffice to say there'll be less of an escalation of those tensions, and presumably a greater probability that there'll be a resolution or ultimately an agreement, rather than just an ongoing deterioration in that relationship.
Let's move closer to home. What economic or market effects do you feel that this new presidency, and we're making the assumption here everything will change, may have on Australia?
Yeah, I think probably the two main ways you'll see that, Paul, will be initially through the financial markets, and then secondly through global trade and through the impact on international trade in general. If we look at the markets, and again, they seem to have responded relatively positively to the outcomes, but certainly for foreign exchange markets, and the US dollar had already been weakening for a few months, partly due to what's been happening with COVID. But I think it's likely that this election result sees an ongoing weakness in the US dollar, a trend that can become well entrenched, and part of that will come back to the spending initiatives from the Democrat administration. Not that they'll go through as quickly as would have been the case if they had a clean sweep, but nevertheless, fiscal stimulus will be on their agenda. So I think we can expect a general trend of some weaker US dollar levels next year, and that should translate to a slightly higher Aussie dollar, and then balanced by what's happening with quantitative easing. Then with the stock markets, look, it's always hard to make predictions about equity markets, but for some of the reasons that I've just outlined, I think there'll be less volatility in stock markets than had been the case, and a greater, perhaps a higher chance of a more balanced uptrend, and less of a volatile path. The Biden administration might be going a little bit harder on perhaps big tech, and some of the antitrust investigations that are already underway might be ramped up, and perhaps that's why we've seen just in the last few days a bit of a rotation out of some of those tech stocks towards the broader market, and some of that's probably been driven by the vaccine news as well. But I think they're probably the main ways that we'll see an impact on Australia through the financial markets. The other side is through trade, and the Biden administration, I suppose in terms of that relationship with China, they'll probably be going a bit harder on things like human rights. That might a little bit wedge where Australia is with China, which is already a little bit challenged. But if we think about Biden as the new president, I do think that overall there'll be a more conciliatory, inclusive approach, which should help with international trade in general. What are some of the other policy changes that you might see that could impact us here? Climate's one where I think there's a good chance that the US will be pivoting on climate, will be recommitting to their Paris obligations, committing perhaps to zero emissions by 2050, and that may well see the coalition government here, might well pivot their policy on the climate, and that might well be forced not just through government decisions, but also where industry is heading with all of this. So I think they're probably the main areas where you'll see an impact, Paul.
Thanks, David. Now, our trading relationship with China is a major economic issue that's very much of interest to our exporters. We hear of difficulties our exporters are having at the moment in getting an ever-increasing list of goods such as wine, barley, sugar, timber, coal, copper, and now even lobster into China. Do you think we're seeing a small bump on the trade road, or are we seeing something more permanent developing?
That's a tough one, Paul, and I hope it is a small bump and not something more permanent. It's pretty hard to extrapolate what we've been seeing with a firm view of what that might all look like in a couple of years' time. And yes, to see timber added to the list after lobster and everything else, it's as though there's a long list and someone's just ticking their way through them, and week by week we hear the next announcement. So obviously there's a political link to this. There's a message that's trying to be sent to Canberra, and that's the way politics works, encouraging perhaps our government to be less critical of some of the policies from overseas. I think that when we emphasise, and this is a mutual situation, that there are mutual benefits of a strong trade relationship between China and Australia. It's good for our economy. It's good for the Chinese economy and Chinese people. So as long as we keep emphasising those mutual benefits, then I think logic will see through. If we look at the actual volumes of trade that Australia's undertaking with China, they haven't fallen too far, and part of that's due to the elevated iron ore price, which is probably offsetting a few other factors. But looking forward, yes, it's up to the politicians, I suppose, to manage that diplomacy, to keep emphasising the mutually beneficial aspects of a healthy trade relationship. And then in terms of our response to all of that, how we diversify, how we reduce or mitigate some of that risk, and how we do our best to be maintaining our positive trade relationship with China, but equally have a few other options to help in case that does deteriorate any further.
And finally, and you've just touched upon it towards the end there, it's been said that Australian exporters need to diversify their export markets. In your view, David, what Australian products could more easily find alternative export markets?
Look, I think probably all products and aspects of trade, all exporters will have for some time been working on diversification, and COVID-19 and then more recently the trade tensions would have added to that imperative. But I'm sure diversification is something that will have been on the agenda of exporters for a number of years. This is probably just up the ante. But whether or not it's food and beverage exports, whether or not it's bulk commodity exports, service exports, so tourism and education. Clearly, we've had given about 36% of our exports by volume head to China. Clearly, we've had a concentration risk there, and there's been a need to diversify, and I'm sure everyone's been trying to. It's a case of how quickly you can achieve that. When you think about Asia by population is 60% of the world's population, so there's a lot of demand on our back door there and on our doorstep, if you like, to feed into. So the Australian government has recently finalised their free trade agreement with Indonesia. I know there's been a lot of talks with India. We still don't have a free trade agreement with India, but obviously a massive opportunity there, although that's one region that's been hardest hit with COVID-19 in terms of Asia. So I'm not sure there's any part of the market that isn't that there isn't an opportunity with diversification. Iron ore is probably the one where China doesn't have too many alternatives with where it gets its iron ore from, other than Brazil. And Brazil is another country that's been devastated by COVID-19. So as I say, I'm sure exporters have been asking themselves for many years, okay, it's great that we've got a market there in China, but where else can we diversify to? And I do think all the events over the last year have just added to the urgency there. And it's a big population out there. So given 60% of the world's population is in Asia, there's a lot of diversification opportunities that aren't too far away.
David, thanks for making time to be with us today. Your economic market and market insights are always very much appreciated.
A pleasure, Paul. Thanks for having us.
That's all for today on Delphi Connect. On behalf of all of us at Delphi Bank, thanks for joining us. Bye for now.